bet on the jockey, not the horse. So go study the operator first and foremost. It is a relationship business. Knowing, liking, and trusting that operator is probably your most important thing you can do. And it's kind of the easiest step for you to take. You can look at the history of the track record of the operator.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris. And today we welcome back Chad Ackerman, actually our first time, second repeat guest. So we're excited to have you back on today. Chad, we've known him for a long time. He's a business coach specializing in real estate who combines 25 plus years of corporate experience with his own journey as both an entrepreneur and passive investor. Chad co-founded the Left Field Investors, a community of over 1,300 passive real estate investors that was so successful that it attracted a buyout offer. I'm sure we'll get into that. And now he helps real estate professionals build thriving businesses while maintaining the work-life balance that drew him into passive investing in the first place. Chad Ackerman, how are you, sir?
I'm doing great. Guys, I really appreciate you having me back on. The honor of being the first repeat visitor to the podcast is not anything I take lightly. So I appreciate you having me back on. Good to see you guys.
Absolutely.
Yeah, you too. Well, we're excited to have you on because we got some new stuff to talk about, right? Your journey has changed since we originally connected. So excited to unpack that because the reality is I think it offers value to the listeners. So we connected with Chad Ackerman originally through the Best Ever Real Estate Conference in Salt Lake City a couple years ago. And they had this community called Left Field Investors, which was an investor community that was born out of the pandemic. They were starting a monthly meetup and just caught it at the right time. Like literally the month you guys were supposed to meet, the world shut down in March of 2020 from COVID. Is that right? Tell us that story.
We were 3 days off from being able to host our first meeting. The world shut down on the 15th of March in 2020. Our meeting was scheduled for the 18th. So we just celebrated. I mean, that was 5 years ago already, which is hard to believe. It was 5 years, but yeah, we were that close. But we're a pandemic baby. We would not have developed the way we did had we not had the pandemic. Probably, I might not be on the podcast with you today if it weren't for that. But we were in the right place at the right time, I guess.
Yeah, and it happened very quickly. So they are a community that because everything shut down, all of a sudden they were like, well, why don't we do this meeting virtually? And since we're doing it virtually, we can invite whoever we want to. So they had out-of-state friends. And next thing you know, this ballooned into a community mostly of limited partner investors, really focused on helping each other get better, on knowledge, on underwriting. And in my opinion, it highlighted what has come to be a pillar for me and what I think is really important in choosing operators, and it's community. A lot of different sets of eyes looking at deals, looking at operators, looking at underwriting, and that community together creates a lot of value. And I think that other people recognize that as well. We watched Left Field Investors have a very rapid rise. We went to you guys as one of your flagship events in Columbus, which was in a baseball stadium, which was awesome. Left Field has always alluded to the idea of these left field investments, these weird ones that come out of left field, something that people haven't been used to. So it was great to be a part of that. And then Passive Pockets, which is the spinoff from Bigger Pockets. Bigger Pockets recognized the value of the community you guys put together as well and bought you. Right. And so from there, you're still involved with Passive Pockets. And I was on that podcast recently and we've had a lot of really great engagement. I love watching that happen. And then you're doing something different now because you got a lot of really great experience that has led up to where we are now. So I've already talked too much, which is kind of my way. Shut up, Neil. But go ahead, Chad. Tell us about, for those that don't know, tell us about who you are, what you're doing now, and everything that's led up to this point.
Yeah. So the idea behind Left Field was selfish generated, right? We wanted to become better LP investors ourselves. And so what do you do when you identify a gap out in the system that there wasn't a place for us to go find a spot to educate ourselves as LPs? We created one. And kind of as you said, we intended just to get 10 or 12 people around a table here in Columbus, Ohio. And when we went on Zoom, that really opened up the market to us that we, as you said, we could invite people from other states. We had people, we would host a meeting in the evenings. We had people in Asia that would turn into our meeting, eating their breakfast while we're doing our dinner meeting so they could learn. And so it was this place that it just struck the right chords. We really kind of built a culture before we had any idea it was a business. And that culture really attracted a lot of LPs. They wanted a safe place to come, share ideas, grow, network with other like-minded passive investors, and share their stories, get educated, because it's a bit of guesswork. You want to be as educated as you can, making right decisions before you write those big checks. So we always tout it, be a part of a community, be a part of multiple communities before it's over with if you want. Just go collect that data so you make a better educated decision before you cut a check to an operator.
Follow-up question on that. One of the fallacies or kind of the jokes behind the scenes is that our podcast is called Truly Passive Income. And the reality is there is no truly passive income, right? Even if it's all on a scale, right? Something is going to be the most active strategy that you could find. I would argue it's probably Airbnb with multifamily in Carolina Beach, North Carolina. That's what I chose before changing tactics. But house flipper or whatever, something's going to be on the far more active side and something's going to be on the far passive side. And even that doesn't mean there's not some work. A lot of times it means vetting sponsors, looking at the deals, making a decision upfront, front loading the work to find the right partners. And then hopefully it becomes passive and you're invested with them for years. But one of the things that I've heard you mention is talking about the importance of being an active passive investor, which is, it's like a jumbo shrimp, right? Or it's counterintuitive, right? So if you're talking about dedicating a few hours a week to managing investments, what are the specific activities that passive investors need to prioritize to both maximize the returns, but also help them lay their head down at night and sleep and have peace that comes along with that?
Yeah, our number one that we would point people towards all the time was bet on the jockey, not the horse. So go study the operator first and foremost. It is a relationship business. Knowing, liking, and trusting that operator is probably your most important thing you can do. And it's kind of the easiest step for you to take. Like, you can look at the history of the track record of the operator. You can ask them questions. You can get involved in their communications so that you have a firm understanding. Go meet other LPs that have invested with them, that have a history, that can tell you. Doesn't mean they're always going to be right. I mean, we can point at certain things that have popped up in the last couple of years that caught everybody off guard. I won't go into specifics, but there have been things that everybody thought was a safe bet, and it turned out to be poor after several years. So it doesn't mean we're ever going to be 100% right, but you can get yourself pretty well educated. Outside of that, the other thing I tell people is stay in your lanes. Pick 3 or 4 asset classes that you want to study and become good at, and know the operators in, know the economy around it and everything else. And that, don't get corrupted by the shiny object syndrome and start fanning out into areas that you don't have a lot of expertise in, and you can end up making mistakes. So, those are the big pieces of advice that we would usually give people.
Yeah. You often say, you want to diversify across asset class, geography, and operator. You don't want to be all in on, what's his name? Bernie Madoff. I was going to say Bernie Mac. Poor Bernie Mac. I'm not sure he's even alive anymore. You don't want to be all in on Bernie Madoff. You don't want to be all in on one syndication operator. You don't want to be all in on multifamily. You don't want to be all in on the Texas market. But you do need to be careful to not chase I need to be in 100 different types of asset classes in 100 different, with 100 different operators. Like you said, go wide, but don't go so wide that you're only an inch deep. Go deep, learn those asset classes, understand what it is you're investing in, learn the demographics around what's driving the demand for multifamily or mobile home parks or self-storage. Understand this operator and how long they've been in operation, and really know, where they've gone right and where they've gone bad. Because even some of the most successful operators that I know have had deals go bad. And it's good to understand what they did when it went bad, because we've talked to people who have had very different experiences on deals that have gone bad with operators that, even where the deals maybe gone worse, but the operator's reaction and the way they took the bull by the horns made those investors say, listen, if I'm ever going to invest in this asset class again, this is the operator that I'm going to invest with.
Yeah, I think it's safe. To your point, Neil, the 100 operators, 100 deals to get in, that's not very passive. That's an active business by all means to manage all that, because there's communications from each of them. You got to manage your K1s, you got to manage your cash flow, make sure that's coming in correctly, exits, refis. There's a lot of work in there. Being a limited partner is running a business, and you need to treat it as such, or that's when you get yourself in trouble. So picking those things to be really good at, would you become a business owner in a broom shop and a microwave sales shop and keep going down the list and do 100 of those? Probably not. So probably don't become that as a limited partner investor either. Pick your few things, be really good at it, study them, know the market, and that's going to help you make better decisions as you go through this.
I want to ask about, this is going to be a little bit more of a statement, but it's leading up to my next question. So we can all identify these challenges of, I'm getting into alternative investing space or syndications, and there's challenges that come along with that a lot of times you don't find out until you're kind of into it. Like, you've gotten to be really good at identifying the challenges, but one of the things that is unique about you and the guys at Left Field is that you also were in the business of helping develop specific tools to help understand that. So like, in terms of like vetting operators, analyzing deals, the power of community really coming into play there. Tell us a little bit about some of the biggest red flags that you're seeing that people need to navigate. And then I want to take that to a bigger conversation after that, with the question really being about, with what you're offering now with your coaching, both to LPs and to GPs, you're bringing so much perspective from the tools that you guys have built, the underwriting that you've done on your own deals, the LP communities that you put together of large groups of people all willing to look at one deal. So tell us, just from the basic level, what are some of the red flags that people need to be aware of? What are the lessons that we learned over the last couple really hard years? And then on a bigger scale, what are you offering, and what's the value that people need to recognize that you're bringing to the table?
Yeah, great stuff. So, yeah, I think the last couple years have really shined the light on areas in the due diligence that maybe we weren't paying attention to 5 years ago. So, later 2000 teens, the market was super heavy, growing like crazy. Everybody was successful. I'll be honest, I got started in 2018 and I didn't pay as much attention to the due diligence as I should have. And I had some very successful hits. What got exposed over the last few years dealt with loan structure, mortgage structure, how to really balance fixed rate versus variable rate structures, insurance costs. That became a big issue. These little things that really blew up really shine a light on doing better at your due diligence, because it's very important. It can expose an operator in a bad situation. I say now there's no better time to be an LP than today, because now you can study who made it through this past couple years as an operator and structured well and had maybe not great success, but they didn't lose their shirt as well, and lessons learned from all of this. Even better, if you can find operators that survived this and the 2008 structure, then they've really had some painful financial lesson learned that hopefully makes them better operators going forward, that you can feel a little safer about as well. So I think it's a great time to be a limited partner. I don't shy away from it. I'm still investing as well. That I believe in the industry, and I believe in identifying those operators that kind of learn through the masses. Who would have expected a global pandemic to hit? Where was that in the risk assessments in a plan? Well, now we've lived through one, so that's factored in. That should help improve where things go. So to your point on that, what I'm trying to do now that we've sold Left Field and I got certified as a business coach, my goal was to take all that experience we gained as being the runners of this LP community and what we learned, and take that back to help the business side of being an investor. Or even beyond that, I want to work with general partners, especially as they're up and coming and they're newer. We learned a lot of information that limited partners want out of deals. I want to be able to share that with up and coming general partners to help them get over the hump and stay relevant and grow their business and so forth. Just because we gain some perspective, I think, of the industry that not a lot of people have by running a community for the last 5 years, that I want to share that information back, give back to the community that helped build what we built I want to stay relevant in that community and help people out to continue forward.
Is the idea primarily are you focused on helping GPs get better and using your experience as an LP to do that? Or is it a wider net than that?
I'd be happy to coach anybody that has a business that has some questions and feels like they could use some help. My focus is going to the general partners. Nomad runs things very well. I don't think there's business coaching that Nomad needs, but I love to talk to you guys because I'm like, you guys probably hear from new operators that are looking for advice. Well, maybe they can use some coaching as well. So I'd like going back into the GP side of things, just because, again, pulling that knowledge from the community that we grew, plus the materials from FocalPoint and the business coaching background that Brian Tracy built, I think there's value to help general partners out. But how many LPs do you know that have their own business that may need some business coaching too? Or, limited partner investing is a business. Maybe they need help with that. So I'm willing to help either side of the fence. I think I can give back to both sides, really.
Yeah, I think you're really well-rounded. It actually brings up, recently we were reevaluating our deal structure. We did everything in the past with a long-term hold vision on individual properties, and then we did a fund. And after that fund, we're moving on to a large project after that. And we know that the fundamentals of the specific project don't lend to our traditional way of doing things, which is a forever hold. We're going to start sprinkling in a few deals that make more sense as a 5-year liquidation. And we want to be clear about that up front, right? Well, that's something new for us. And with something new comes a new deal structure. So I think of it as the perspective of, as a general partner, how do we go out and we listen to what the market is telling us as to what retail investment product we need to bring to the marketplace to get investors to want to partner with us on something that is really hard to raise capital right now because syndication has taken it on the chin over the last 24 to 30 months, right? So that perspective of we're trying to put the best deal forward that we can. What do the investors actually even want right now? And for me, I certainly understand the value of your position is that you can give us perspective as to what you're seeing from all the deals that you've looked at with all the different GPs, but you also have well over 1,000 limited partners behind you that you can access and you have, access to in terms of, hey guys, what do you want to see? Help us put together the best offering that everybody wants, right? For the LPs and the GPs in the middle. So in my mind, I've been in the position of being one of the general partners where we are looking for a who, not how. Like instead of how do we answer all these different questions, it's who do we know that has access to a group of people that can help us navigate this. And so from the GP side of things, I think that's the position that you could easily step into. And then at the same time, like you said, LPs left and right are full of questions that I think you could speak to as well.
No, I think that's fair. I think a solid general partner, it's some blend of consistency, but also being ready to pivot and being aware of what the market's giving you now. And in all of that, to help the LP, the best thing for a GP to do is solid communication. Explain why you're changing, you're pivoting your strategy. Explain the logic behind, we've always said we were buy and hold and sit on it forever, perpetuity. Now we found some asset class or some deals in our asset class that make better sense to flip in 5 years, 7 years. But here's why. And that explanation, that's solid to a limited partner to help them understand, okay, this is different, but here's why, and they've studied it, and here's, the logic behind it. And that holds a lot of clout to the limited partners then.
As the chief operations, you were COO at Left Field, correct?
Yeah, correct.
I've heard you mention previously the need for business coaching firsthand with Left Field investors before you became a coach yourself.
Yeah.
What specific challenges did you guys face scaling Left Field investors that you think now can help your clients overcome?
Yeah, it was a daily thing that we had struggled with for sure. We were not entrepreneurs. We were all kicking into our passive lifestyle and wanted to just kind of start a community, and the community grew so quick and operator deal flow came to us so quick that, we turned around, oh, shoot, this is a business. Wait a minute. We need to act a little bit differently. So we were behind the eight ball, I feel like, just about most of the time. retroactively moving through building our business versus being proactive throughout it. That's where we always felt like we needed to write a more strong business strategy for what we were trying to do so it could focus us, as opposed to just saying, here's, a squeaky noise over here, let's go react to it. It worked. We were able to slap things together for a while. It was not efficient by any means. But we were light on our feet. We were just making it up as we went along, is what it almost felt like, figuring it out anyway. It always felt like we would talk about it. If we had somebody who could really help us focus the business, what could we grow left field into? Then we discovered, the relationship with Bigger Pockets. And we're like, well, the resources that are there, the strategies that are behind it already, that's going to be able to take the left field community to that next level that we could get to probably, but we were wearing ourselves out at the same time. So it was nice to get the help that we were able to get. So that's what I wanted to help avoid other small businesses from feeling that same pain that we did, help them become more strategic, more effective, more efficient with their time as well.
I want to ask a selfish question. I have a natural aversion. I'm pretty hard-headed and stubborn in my own right. Thanks for nodding. That viewers would be nice to know we have video as well as audio, Neil. Appreciate that. I've tried to become a lot more receptive as I've gotten older, mostly from my own shortcomings and things that I've gotten wrong that I thought I had right. And I try to listen to a lot more books, a lot more podcasts. And, that whole thing of who we are right now is who we're going to be in the future, with the exception of the places we go, people we meet, books we read, content we consume. I'm curious to know what your perspective is in the difference that you see over time of the people that are willing to accept coaching and the people that don't, right? The upper echelon of successful people, I'd be curious to know what percentage of those you think are accepting constructive criticism and coaching versus the people that don't. And I think that there's a conversation here to be had about the biggest investment you can really make is probably not into your portfolio, it's probably into yourself. So tell us a little bit about coaching and what you see there and the value that brings.
Yeah, no, that's great. First off, we're all proud of your growth, Clint. So keep it up. Good job. No, I think it's spot on. I think in situational circumstances, anybody can be successful. My thing is, as a coach and strategist to align with you and your business, do you want to get your business there riding a bicycle, or do you want to get there driving a Lamborghini? And that's kind of how I view the difference of, you can probably get there and you're going to make some, different tactics along the way that are going to work or aren't going to work, and you're going to learn from your mistakes. But how much helpful would it be to have somebody along that's a non-equity partner that's helping you think through and talk about strategy and give a second set of eyes to look at things? One of the things they talk about at FocalPoint is, you as a business leader, you get to the top. Well, when you have questions, where do you go? There is nobody above you to go to talk to. You go home, talk to your spouse maybe, or your plus one, but are they, business knowledgeable? Are they really going to be able to help with those situations? Or are they listening? That's the perk of a business coach to bring in, is kind of a sounding board, somebody to look over your shoulder, kind of coach and walk you through some ideas that just helps you think through the whole process and be more effective and efficient with your time, is what it always leads to. And we focus on time, team, money, and strategy is what we really try to help out with. At the end of the day, we aren't consultants. We aren't going to tell you what to do. We're just going to help you think through the process. And we've got materials to help think through the process. But, it's there to help just provoke that strategy build and get you to a better place than you might be able to do it on your own.
There's 4 general partners at Nomad Capital. There's Clint, myself, Eric, and Levi Hemingway. And we, something that we often talk about, and you sort of mentioned this, is, a lot of times we're the only ones that we can talk to about the stuff that we're dealing with. There's not a huge, we can go home and whine to our spouses and but they're just going to kind of nod their head and go, yeah, whatever, quit your bitching. But it's, but at the same time, oftentimes in a business partnership, there's competing interests sometimes. And so sometimes maybe it's nice to have an outside party who's not doesn't have, like you said, doesn't have equity, to maybe help you navigate some of that. So I think that's
great.
a powerful
Hey,
tool.
I'm willing to do the first time signing up a client on a podcast. I'm happy to do that with you guys if you want.
Switch your out for a leather couch here, Neil.
Yeah, this will be epic.
Yeah, hang on. Let's let me. Yeah.
I've got a follow-up comment on that. Actually, I would argue, syndication, most of what we're talking about, you're a business coach that can help with a lot of things outside of just pigeonholing you to LP and GP challenges, right? So that I don't want to sell you short on that. There's a lot of other places that this can go. But obviously, you're coming from a background of the syndication world, capital raising, deal structure, and risk mitigation, everything else. Alternative investment strategy has really only been around since 2012 with the Jobs Act. It is a very, very young industry in terms of appeal to the broader masses. And I would argue that it's becoming broader. We just had a change recently where, it's easier. The accredited verification used to have higher standards than an adjustment that just went into place. If you're making an investment of $200,000 or more now, that's good enough to count for your accreditation status, right? If you don't know differently about that investor. So it seems to me like things are opening up. This is not going away. It's becoming more and more commonplace, but it's still very young and very fragmented. And I would argue because of that, coaching is probably more valuable now than it will be 20 years from now. As it becomes more commonplace, there's going to be more resources in this space. Left field investors jumped out and had success because nobody else was doing it the way that you guys were. With the focus on, instead of the top guy trying to make a bunch of money, it was about community. It was about sharing. It was about being vulnerable. It was about having an abundance mindset. And I think that's why you guys grew so quickly. And that doesn't need to change with the people that carry that. There's still a lot of value there. And I have a lot of friendships that came out of that group. But the reality is, I think that the coaching is worth more now because there's more risk involved now. As it's consolidating, we're going to have more and more history. You give it 2 or 3 market cycles that we go up and down through syndication over a 30, 40-year period, you're going to know who the good operators are and who aren't, right? And things are going to happen and people are going to get caught with their pants down. And, Warren Buffett says you never know who's skinny dip until the tide goes out. Well, the tide just rolled out over the last couple of years, and anybody with variable rate debt or bridge debt or anything else got exposed. And there's a lot of challenges there. And because of that, I think the real question is, what did we learn, right? What did we learn over the last 2 years? And I think we all learned a lot about bridge debt, variable rate, interest rate, preparing for the unexpected, and things like that. So I think that it may not be obvious to anybody else, but to me, living this daily and the challenges we faced over the last couple of years, like, boy, the money that you could spend on coaching is likely what you're potentially saving yourself is probably 10 times that amount, if not 100 times.
I agree. I think that's part of what led me into the coaching gig as well. Post LFI was, I always thought it would be great as a legacy of left field to leave a mark on the education side of things, of exposing this industry to more and more people. You guys know I formed a tribe and I put my 2 teenage kids in it so I can invest alongside with them and educate them so they can make better decisions in their teens, 20s than I made because I didn't find out about this until I was in my 40s. So just trying like any of that we can expose to a younger generation earlier on in the process so they know they have choices, that it doesn't have to be 401k, Roth IRAs, and that's it. There are other options out there that are viable, but you got to get educated in it and understand it. And diversity is probably king at the end of the day, of left field, right field, as we called it, all across the board. But understand this other space that you could play in that can do a lot for your wealth development as well.
So you have been on both sides of passive investing as an investor yourself and as an equity partner building a community of investors. So how has building and selling left field investors influenced your approach to evaluating deals and sponsors compared to when you first started?
Yeah, well, I mean, as with anything, the more times you do this and get burned on things, the more you're going to learn and grow and be better at it, hopefully. The biggest part of being part of left field that made me better is just the stories. I used to host a podcast called The Spotlight that we would just ask limited partner investors to come on and tell your story, your journey to getting in. That was so valuable just to hear the different ways that people got into the business and what they're doing now, because it opened up spots of the industry that I hadn't really paid attention to. So all of that helped. Selling the business then just gives you a whole different perspective of the end result of all this as well. How big the nuances of selling a business, selling a major asset. There's a lot of work that goes into that maybe you don't appreciate when you're sitting on the sidelines as a passive investor, that you need to appreciate those operators a little bit more of all the work they do go through, that they're not just taking your money and not talking to you anymore kind of thing. So it was valuable to go through the whole process, the journey that it's been the last several years to get myself ready for, okay, what's next? What are we going to do from here?
So what are your sentiments on, so we just got back from Best Ever Conference a few weeks ago. Without giving away too much, tell us what your sentiment is on the market right now. Things are a little shaky right now. Honestly, it's changing from week to week, right? We have tariffs about to go into place. We've got interest rates that haven't come down yet, but are supposed to come down later this year. So kind of give us your sentiment on the market, and then not asking for a Nostradamus prediction, but tell us about any kind of asset classes that you feel bullish on that you think have a good couple years ahead of them.
Mm-hmm. So great question. God, who knows? I don't feel like as long as I've been doing this, we've ever had a political climate like we've had now, where there's so much influence coming out of DC these days that really we're kind of, I don't know, I'm cautious, but I'm optimistic still. Asset classes, it feels like multifamily is starting to come back out of its day. The Midwest seems to be kind of having its time in the spotlight for a while, as the Sun Belt was so popular for so long. So there are pockets, there are elements that seem like they're doing well. I still love the triple net lease kind of model, and depending on the industry that it's in, as long, how it might be affected by the current economic climate might drive some of that decision too. But I love that model. I love self-storage still. I think especially what you guys are doing at Nomad, when you can buy in at the level of the capital to get in that you guys do, I think there's a lot of solidness to those investments still that makes sense. So, I love to see that more of that come. But it's a weird climate right now, because you're right, it changes weekly almost of what is influencing the market right now. Let's wait and see. So I think there is a lot of people sitting on the sidelines, holding cash, waiting for that. But the energy feels like everybody's like, no, it's close. It's getting ready to go again. Have your cash ready and do your, to me, now's the time to get educated. Now's the time to do due diligence. Go meet new operators. Go study asset classes more. Ask the questions so that when you feel right, you've got your capital ready, but you've got your questions answered so you can be ready to go too.
Yeah, one of the things that I've noticed is that there's a lot of money that's positioning into debt funds right now they don't have to make a killing, but they're trying to make a decent 8, 9, 10% interest. And to me, a lot of times that comes with earlier liquidity options. You can get your money out in 30 or 90 days or whatever it may be. To me, that feels like money that's sitting on the sidelines, that's waiting on the next big thing to pop off, and they just want to hold it and have access to it fairly quickly. To me, that feels like putting money out there, but like getting half the return that you could have gotten a few years ago, but having access to it in case you want to move into something else. So I totally agree with you. And we're seeing a lot of those debt funds, income funds type things pop up. And to me, that feels like a new bucket that never really would have taken off 5 years ago. And because so many people took it on the chin and lost money for a couple years, that seems like a very viable option for people that want to park capital right now. For the triple net lease stuff that you're looking at, any particular operator that you want to name drop that our investors can look into, or if you're not comfortable with it, or if they need to pay for coaching first, that's fine too.
There you go. I'll collect on the side. No, I've had a lot of good luck with Mag Capital. Drew Walgren is great to work with. His brother Neil's great too. That whole group, they seem to make a lot of good decisions around that space. Their track record says a lot. I think, especially, I had a deal go full cycle with them recently that they bought in 2020, I think. and it performed. And it was like a case study for them to say, look, we bought in the pandemic in all this rate craziness that's been going on, and it still came out okay. So the model is working, is what they kind of felt like. And I have to agree. I think they've done a nice job.
Well, I think that left field investors ended up placing more capital with Mag Capital than every other group combined. So good job dancing with the one that brought you, Chad. No, they've been a safe, consistent, solid, and a few home runs too, but like solid base hits for a long time. So that seems like something that has not been ruffled by the market.
Yeah, give me a bunch of base hits in this market, and I'll be happy with that. So
totally.
I'll take it. Mm-hmm.
Completely agree. That'll get you to the Hall of Fame. Good deal.
All right, Chad. Well, we're going to put you on the spot, given that you're our first repeat guest, and we're debuting a segment that I want to keep doing, but we didn't warn you beforehand,
or me,
or Clint. So I'm taking control here. So, what is one book that you find yourself recommending the most to friends and colleagues?
That's an easy one, and this is going to be a softball for you, but it's Brian Burke's book, The Hands-Off Investor. There's not a week that goes by that I don't recommend that book to an LP that's getting into the space. And I think it's one of the most solid books about investing as a passive investor. It's very in the weeds of due diligence, but it's so important to know that. And Brian did an excellent job of laying it out there. So that's my go-to for sure.
We might have to start making that a recommendation to our investors. Is that an audiobook form by chance? Do you know?
It is. Yeah.
Okay. I'll download that today.
And we've got Brian Burke on the schedule coming up.
We do.
So
we'll have to see if we can get him to donate 4,000 or 5,000 books to.
Yeah.
Happy to have you on, but you need to give us $10,000 worth of free material to give out. That's great. That's a great recommendation. Nobody's made that suggestion so far. So excited about that. And we'll be able to dig into that with Brian. All right, Chad. Well, listen, Chad Ackerman, thank you for joining us yet again on Truly Passive Income. It's been so great connecting with you over the years, watching our relationship change and watching your trajectory change. So very excited about what you have going on next. It was my idea to bring you back on because I know that you have a lot of value to add, and you've added a lot of value to me and the way that I think about things as well. So thank you for that. Thank you for the time. And if any of our listeners want to connect with you, hear more about what you're doing now, or talk to you about coaching services, what would be the best way for them to do that?
My website's the easiest thing at chadackerman.focalpointcoaching.com, or reach out to me on LinkedIn. Happy to connect there as well. So
that sounds great. We'll make sure and put that in the show notes. And thanks again, Chad Ackerman. Really appreciate your time, man. Thanks for being here.
Thanks to both of you. I was excited to bring this new concept that I'm doing to you guys because I know you bring a lot of energy back to me. So I thank you for all your partnership and support through the years as well. Really enjoy it, guys.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode. Leave a comment down below or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.